Donald Trump has now been president for 100 days since taking the oath of office on January 20th. It is fair to say that his vision and rhetoric have been polarizing, in keeping with the very partisan nature of U.S. politics over the last several years. Trump is, however, a very different president from previous ones, in that he came to office with no government experience. Rather, he's built a successful real estate business through numerous discrete deals. Seen in this light, he is a far more transactional figure than previous presidents and will look for high-profile victories on issues that are of importance for he and his supporters. Case in point, from a market perspective, the ability to successfully pass tax reform is the single most important issue for the Trump rally to have lasting power in our view. We want to emphasize that our team remains bullish on stocks over the long term. While the media's fixation on accomplishments in a leader's first 100 days is admittedly arbitrary, it is at least a good gauge of early momentum. In our view, Trump's record is mixed at this point. Most significantly, we've seen the very public failure to pass healthcare reform. On the other side of the ledger, Trump was successful in getting his Supreme Court nominee appointed. Trump does not have strong approval numbers. While his approval of Americans has ticked up slightly, at just over 40%, it still sits well below any other modern president. Ronald Reagan, by contrast, had 68% approval ratings at this point in his mandate. The silver lining is that slightly more than half of respondents do see Trump as a strong leader, a number that was probably helped by the missile strike in Syria in retaliation for the regime's odious use of chemical weapons. The issue is that with Trump's low poll numbers, it may become harder for him to pass some of his more ambitious and equity-friendly proposals. Most notably, tax reform, and especially a lower corporate tax rate, reduced economic and financial regulations, and increased infrastructure spending. At the very least, this could delay passage of some of these initiatives. Tax reform in particular could be pushed back to 2018, which would be a headwind to stocks in general. Which brings us to the 10% plus rally that we've seen in the S&P 500. The TSX is up 8% in the same period, since Trump's November 8th election. While economic data has certainly been supportive, at least some of the rally can be attributed to Trump's promises. Since quantifying the exact impact of these variables on the market will always be an approximation, if we gave him credit for half the rally, this is the amount that is at risk as investors start discounting a lower probability of equity-friendly measures passing. The amount of risk is not evenly distributed among sectors. Looking at the performance of the 24 S&P industry subgroups since Trump's election, banks, technology hardware, insurance companies, and infrastructure-related stocks are examples of industries which could give back some of their recent gains in an adverse scenario. Banks and technology in particular are up more than 20% in this short span. Even more importantly for the bond and equity markets, the so-called reflation trade has faded as investors start to assign lower odds to some inherently inflationary measures passing soon, tax cuts and large infrastructure spending in particular. The bottom line is that there is still time to pass some of the more ambitious and market-friendly proposals, but investors will be looking for tangible progress more than rhetoric over the coming weeks and months.